it's been fascinating to see all the numbers trickling through from a lot of the research houses with regards to gold, platinum, and a vast range of commodities. Let's delve into the GFMS. They're talking about an average gold price in 2011 of $1,455 an ounce, but did say that we could be at that 1,600 level by the end of the year, citing negative real interest rates as one of the biggest factors. Tell us about some of these numbers and whether you think you are buying into this low interest rate story at this point, or whether you think we are going to see a significant shift in the middle of 2011 if quantitative easing also changes.
Yeah, I think it's very interesting to see their research piece today, and they cite a number of the common themes that's often behind the gold price rally, the sort of net buying from central banks. They've often cited the increase in the jewelry demand business and generally the physical demand for precious metals as a big push. I think we're probably on the same page with them. Last week we put out a big super cycle piece on gold. Our research analysts here at Standard Chartered did some detailed work on trying to look at a longer term forecast for the gold price. Certainly we look at that developing story of growing Chinese and Indian physical demand as being a massive driver in the price. We kind of look back at where the gold market was maybe 10, 20, 30 years ago, and think about when Chinese and Indian consumers of gold probably their GDP per head was down at something like 2% of what it is in the US, probably like $300 a head in China and India. We think that's probably this year going to come in at about 6% of US GDP per head, and our long-term projection for that is moving to something like a number like 30% of GDP per head in 2030. So a dramatic increase in the wealth of a population which are really behind the growth of demand for gold at the moment. Probably we're thinking something like last year Chinese and Indian demand for physical gold was something like 51% of the growth of the market. So overall, we generally look at that and think overall there's going to be a huge swelling of demand for gold going forward. I think that a lot of the inflationary concerns are probably not as big issues as they were over the last sort of 10 or 20 years. I think that now we kind of look at how emerging markets are developing and their ability to be able to purchase gold and be a new demand factor in the equation. Some of the things that the GFMS report cited, like the decrease of the global hedge book for gold, a lot of producers have successfully unwound in a very high profile way, unwound a lot of their hedge books, and that's really come out of the market. So we're looking for something else now to take gold to the next level, and I think we definitely are on the same page. We think that the burgeoning increase in physical demand is definitely going to come from the emerging markets. We put out our own forecast, something like by 2014 we're targeting over $2,100 an ounce for the average of the year. So I think even more bullish than those headlines from GFMS.
Well, it's fascinating. Let's delve into some of the BlackRock numbers that were also out. I mean, they're talking about favoring platinum over the other metals because of production constraints, and also because we see plentiful supply for silver, and the days are numbered for gold's overperformance as well. Are you buying into that story? Because platinum in a sense is very similar to gold because it's got that investment side, investment element, but also has that industrial element which is very pertinent.
Yeah, definitely. The boom in the auto sector, across the emerging markets is going to be something that's really going to drive this metal over the next decade. We're fully bought into that idea that we're going to see a dramatic increase in the consumption from the Far East and also in the Middle East, where we're seeing large refinery demand as well for platinum and palladium. So consequently at this point in time, I would definitely say that the platinum gold ratio is going to see gold get a pickup from the overall physical demand from the jewelry sector, but that industrial angle for platinum and palladium will really see it get a lift as we go through the next few years.
We keep talking about how gold, platinum, silver is going to increase its allure from the investor community. If we do see the unwinding of quantitative easing, is this going to create a sell-off in the ETF market and thus add pressure to gold, silver and platinum?
Yeah, I think it's really hard to pick a top for that, because if you look back at the successful ETF growth and the other instruments that you have for the precious metals, and it's only been a year or so since we've created a platinum ETF and a palladium ETF that's really taken off in size. But you look back over the long run history for the gold ETF, it really has been a very dramatic growth story that has tapered over the last year or so. So I think that the potential for it to leg up and go another level higher is in the spotlight at the moment. There's a question mark over that. You know, is gold really an inflation instrument? You know, something to beat inflation and protect yourself against that, or is it, does it have other connections to geopolitical concerns? Those were always the main staples of people's argument for buying gold. I think at this point in time, though, you have to look at the creation of a whole new market, in the emerging markets, and that's something that previously, we'd always relied upon the model for the supply-demand factor really coming from the Western world. I think that what's really going to be the game changer for a lot of these precious metals will be the huge growth we're going to see in the emerging markets, and especially the Far East and China.
To what extent is the volatility with the oil price adding to the allure for a lot of these investment metals? We're looking at Brent crude rallying again today, up 1.2% after coming under pressure yesterday, $122.40 a barrel. Do you think that once we see a little bit of softness coming through on crude, that could perhaps create a sell-off in the investment metal space?
Well, it's interesting. I mean, you talked about the GFMS report earlier, and they put their average cost of production for gold as something like, for 2010, I think they were saying a number something like $557 an ounce. The prevailing price of closer to $1,500 an ounce. You've got to be thinking that the energy component of that price is not really a significant marginal cost in the overall demand sector. People aren't thinking about the energy price of the precious metals. I think it's much more relevant for industrial metals like aluminium. The whole complex has moved lower over the last couple of days on the base metal side. Copper getting hit quite hard, and if you look at the one that stood up the best against that is probably aluminium. People obviously having a significant proportion of the aluminium price coming from the price of electricity tariffs globally. That's the one that's really getting a support from a high oil price.